I've never been there.
So I think there's some effort so much that revenue they used to get from I know, and I'm kind of with you on that. Because part of the reason all you can see from it is came in pretty low. Probably should have done this like 6 months ago. Right.
Okay, perhaps we should make a start. Do I need to use the microphone? Okay, I'll use the microphone. They always say it. Okay, so if you haven't met me before, I'm sure many of you have. My name is Mark Taylor, and I'm delighted and privileged to be the Dean of Olin Business School. And in fact, I recognise many of the faces around the room, guests, students, alumni, faculty and staff, and thank you for taking the time to join us today for this research presentation. And this is part of our business research series. In fact, the business research series is particularly about the application of academic research, where we seek to share the research of our world-class faculty with the business community. And by coming together, joining research with practice, we hope to be able to improve that relation, improve business. And the way the business research series works is that it's part of the Olin Award, right? So faculty submit papers to be considered for the Olin Award. The Olin Award is reviewed by a panel of highly distinguished judges from all sectors in the corporate community. And the best research is chosen to be featured at these business research series. In fact, we have today the genius behind this idea of having the business research series and the Olin Award Dick Mahoney, our distinguished executive in residence, former CEO of Monsanto, and Olin has benefited tremendously from Dick's vision and generosity and support over the years, has made programs like these possible. Continues to challenge us, and just now, challenging me about a few things about what we should do in terms of placing our students in different parts of the world, just while I was having lunch. It continues to make us think about the practical application of research. Dick is typical of Dick's humility that this isn't called the Mahoney Award, it's called the Olin Award. So I therefore make a point of actually pointing out Dick's great support for this the research series. So on behalf of the Business School, again, thank you, Dick, for all you do for us. I don't need to tell you, perhaps, that something that struck me, I've been here almost exactly 3 years, is the very high quality of the faculty here at Olin Business School. And I find that truly inspiring, not only in terms of the intellectual capital that they have, but also the impact their applied research has on real-world business issues. And we're going to see some of that today in Todd Gormley's work. And in fact, we have a strategic priority. It's actually built into our strategic plan to put the business community front and center at Olin, and our exceptional faculty help us do this. And if you feel we can be of service to your organization, please contact me or a member of the corporate relations team who are here today. Okay, so let me say a little bit then about Todd. Todd is Associate Professor of Finance and Academic Director of the Global Master's Degree in Finance. He is actually into his second stint as a WashU Olin researcher and faculty member. He originally joined us in 2006, moved to the Wharton School in 2009. We didn't have to hold that against him, and I happily accepted him back into the fold in 2016. And he served as an associate editor for some of the top journals in finance, for the Review of Finance since 2017, and for 3 years until 2018 as an associate editor of the Review of Financial Studies. Todd's research focuses on why managers sometimes fail to act in the best interests of their shareholders and what governance arrangements might mitigate those conflicts. His most recent research has analysed the impact of passive institutional investors on both firms' governance structures and the strategic choices of outside activists. Todd earned his doctorate in 2006 from the Massachusetts Institute of Technology, MIT. It's a very great pleasure to have Todd come here and talk to us about his research today. We're going to be finishing pretty promptly, around about 20 past the hour, as there is another meeting that follows up against. It's actually about reviewing research of our faculty for promotion, right? It is apposite. But for now, let's hand it over to Todd, and then we'll have some question and answers at the end. So, Todd.
Great. Thank you, Mark. Is the mic working? Okay. So thank you for the introduction, Mark. So this paper is joint work with one of my former PhD students, Ian Appel, who's now at Boston College, and with one of my former colleagues at Wharton, Don Keim. So we got interested or started on this project because we noticed that there were sort of two big changes occurring in U.S. stock ownership over the last 15 to 20 years. And Don, Ian, and I kind of wondered if these changes might all be connected, right? So what were these two changes? The first is that there's this rise of activism. Okay, now what do I mean here? What we're referring to are these activist investors, think of like a hedge fund, that takes a 2 to 5% ownership stake in a company and then agitates for change, right? Changes that they think will improve value. Right? So these type of investors have become increasingly important over the last 10, 15 years, and it's been noted in a lot of popular press sources. So for instance, The Economist had a nice article on them in 2015, and it pointed out that if you look at the S&P 500 firms, within the last 5 years, 1 in 7 of them at some point in that 5-year period have been targeted by an activist. Right? Wall Street Journal also was writing a lot about them, not so much in terms of the quantity, but in terms of the type of campaigns that they were running. right? So in recent years, activists have been much more aggressive in terms of going after board seats, and they've also been more successful, okay, in that they get more settlements, they actually win board seats, they get companies sold, and so on. Okay. So that was sort of the first trend that we noticed in the data. The second one was related to some of our earlier work, and that is that at the same time that you see this rise in activism, at the other end of the ownership spectrum, you see an increase in index investors, right? So in particular here, what we have in mind are the big institutions like Vanguard, BlackRock, State Street, where they're primarily offering these funds that are designed to track some benchmark at a very low cost. Okay? That accounts for about 80% of their business. These index funds have become very, very important, right? Their share of US companies' ownership has quadrupled in the last 20 years. Their share of mutual fund assets has also quadrupled, right? If you just look at Vanguard, BlackRock, and State Street, which are the three biggest indexers, on average, for a US publicly listed company, those three combined own about 20% now, okay? So they're very important. So we have this rise of activists, we have this rise of indexers, and what Don, Ian, and I were interested in is maybe these two trends are related, all right? In particular, we had the idea that it's possible that the growth of these indexers is actually contributing to the rise of activists and actually facilitating that rise. So that's what we're going to try to study in this paper. Okay, so basically what we're going to do is we're going to try to look at when a company and its shares are held by more of these indexers, does that seem to affect what the activist does after it targets that company? Right? Does it affect the goal that the activist sets? For instance, are they going to be more likely to go for a board seat, which is one of the more ambitious campaigns, versus just writing a letter to the managers or writing a letter to the shareholders? Okay. We're also going to look at their tactics, right? Does the presence of these indexers seem to matter for the likelihood that the activist is going to go for a proxy fight, okay, rather than something a little bit easier like an exempt solicitation? And then finally, we're going to look at the outcomes. Does the presence of these index investors on the ownership of the company seem to be related to the likelihood that the activist is successful in whatever it's trying to achieve? Okay. So we go into this project having a sense that the rise of these passive investors could be contributing to the activists, and I'll give you some reasons why we thought that was the case. But I want to be upfront that there were also a lot of people at this time, when we started this paper, that were arguing that the rise of these passive investors was actually bad for activism. Okay, and so I'll go through the reasons that they give in a second as well. Okay, so why might they contribute to the rise in activism? Okay, two basic ideas. One is that somehow the growth of these indexers is lowering the cost for these activists in terms of when they decide to launch a campaign, making it easier for them, or somehow they're increasing the likelihood that the activist is going to be successful. Okay, so why might that happen? Well, in terms of the cost side, one of the arguments out there is that this index industry is very concentrated. Vanguard, BlackRock, State Street, those three alone account for 80% of all indexed assets in the US. Okay? And an activist, when they target a company, they typically, again, only have 2 to 5%. If they're going to push through major reform, go to a proxy fight or to a vote, they need the support of other investors. Okay, so one of the more costly things that they have to do is go around to other investors and rally support. Right? And that's more difficult if the company is widely held, where each investor holds a tiny proportion. Nowadays, the argument goes is that it's much easier for the activists to target these companies because they can just go speak to Vanguard, BlackRock, State Street, and they've spoken to 20% of the ownership. Okay? And then they, by having repeated campaigns, there's sort of a repeated game here where they have created a relationship with these institutions and their governance divisions. Okay, so that's one way in which their presence could help the activists. In terms of the benefits, one thing that sets these indexers apart is that they're not holding these companies often because they like the management and how the company is being run, but because they're in some index, right? And need to hold them because they're in the index. From an activist perspective, that could be a very good investor to try to build a campaign on, because this is not an investor that's not necessarily very happy with the company. They can't sell, though, because they're in the index, right? So the activist can come along and say, hey, I'll clean things up, okay? Another way in which the indexers could benefit the activists is that they're not going to sell anytime soon, right? They basically hold all the companies in the US, right? So for an activist, that's very important, right? If you're going to launch a campaign against a company, take it to a proxy fight, take it to a vote, You want to know that these investors that you're going around to trying to convince to side with you are actually going to be there on the day of the vote. With an actively managed fund, you don't know that, right? They could sell their position before the vote. Indexers won't do that. Okay? So these are the reasons why the growth of these indexers could actually help activists. Okay? But as I mentioned earlier, when we started this project, it wasn't clear because there were a number of reasons why they might not help the activists. Okay, so what are those? Well, one of them was talked about in the Economist article from a few years ago. And the basic idea was that these are lazy investors, right? They don't really care how these companies are being run. They're not paying any attention because they just hold thousands and thousands of companies, right? Now, from an activist perspective, if that's going on, this is not going to necessarily be helpful to you because you need to rally the investors to side with you. But if they're not paying attention and don't care, that might be harder to do. A second reason why the growth of these indexers might be harmful to the activists come from the activists themselves. And this is something that Bill Ackman was talking about, and that he argued that, hey, there's a conflict of interest here. Where do these big institutions, Vanguard, BlackRock, get a lot of their money? Well, it's from managing pension funds or retirement accounts of these big public companies. Okay? They're not going to want to be seen as siding with activists is going to hurt their business. That was his argument. Okay? So if that's the case, then maybe their growth is not good for activists. And then the last reason why they might not be helpful to the activists comes from the indexers themselves. Okay? And that they just simply might have different goals than the activists. Right? The indexers view themselves as long-term investors. They're going to be holding these shares for a very, very long time. Okay? And this is something that Larry Fink, the head of BlackRock, has talked about, and that he says, hey, many of these activists are short-sighted. Right? And that they come in with these campaigns, they want to ramp up payouts, they want to ramp up leverage. That might boost the short-term share price, but it's going to hurt the long-term share value. Okay? And we're not going to support that. Right? So if that's what activism is about, if activists are really in there for just the short-term gains, then the presence of these indexers, these long-term investors, is not going to be helpful to them. Okay? So as you can see, it could go either way. The growth of these indexers could be helpful, or they could be hurting the activists. Right? So what we try to do in this paper was to establish what's going on. Okay? Now, the naive way to do this would be to just basically let's divide up companies that have been targeted by activists, those that have a lot of index ownership versus those that don't have a lot of index ownership. And let's just look at what happens to the campaigns of those with a bunch of index ownership and those without, and just see how they're different, and then attribute that to the index ownership differences. Now, the problem with doing that type of comparison is that companies that have more index ownership than other companies probably differ in other ways that could matter. Right? So one reason would be, well, why do you have a lot of index ownership? Probably because you're in a popular index, like the S&P 500. Well, what type of stocks does the S&P 500 pick? It tends to pick the more liquid stocks, right? But a stock's liquidity could also matter for what the activist does, right? So if we observe differences between how these two companies behave, we would have a hard time telling, is this because they have a difference in index ownership? Or is it because the two stocks have very different liquidity? Right? Past performance also matters, right? If you're a poorly performing stock, you're going to drop out of the index, which is then going to affect your index ownership, which could then affect what an activist does. Right? So again, we'd have a hard time disentangling, is it bad past performance that mattered or the difference in index ownership? So to get around this challenge of confounding factors, what we do in our paper is we try to make use of variation in index ownership or passive ownership that occurs because of whether a firm is assigned to the Russell 1000 index or the Russell 2000. In particular, firms that are close to the cutoff for those two indexes. Okay, so for those of you who are not familiar with it, the Russell 1000 is supposed to capture roughly the 1,000 largest companies in the US in terms of market cap. And the Russell 2000 is supposed to capture the next 2,000 largest. So those kind of rank 1,001 down to 3,000. And what we know from the data, and I'll show it to you in a bit, is that being assigned to the bottom of the Russell 1000 versus being assigned to the top of the Russell 2000 is going to make a big difference in your index ownership. Okay, even though you're going to be two very similar stocks. So think of a stock that was ranked 1001. It's the 1001 largest stock, and then you have a stock ranked 999. Okay, 999 gets put into the Russell 1000, 1001 gets put into the Russell 2000. They're very similar otherwise, but there's going to be a big jump in the index ownership of the Russell 2000 stock. Why? Because the Russell 2000 is a much more popular benchmark for all of these index funds. Okay, so we're going to make use of that type of variation to tease out what is the impact of index ownership on these activists and the strategies that they employ. All right, so let me give you a little bit of detail in terms of how the Russell constructs its indexes. Okay? So basically, starting in 2007, there were 3 things that mattered for which index you're going to be assigned to each year. Okay, so Russell reconstitutes its indexes at the end of June every year. Okay, so once they sort them at the end of June, you're in that index for the next 12 months. Okay, now the 3 things that matter for which index you end up in are 1, your end of May market cap. Okay. The second thing that matters is which index were you in the prior year. And the third thing that matters is how close is your market cap ranking to the cutoff between the 1,000th largest stock in terms of end of May market cap and the 1,001st largest stock. Okay, so how do these 3 things matter? All right, so basically there's a 3-step process they use. First, they rank the stocks at the end of May based on their end of May market cap from largest to smallest. So 1 has the largest market cap all the way down, okay, to 3,000. Second, they say, all right, if you fall within a certain range of the cutoff between the 1,000th and 1,001st divide, you're going to stay in whatever index you were in last year. Third step, otherwise, you move into the index that's appropriate for your size. Okay, so if you were a stock that's 750 in ranking, you're going to get put into the Russell 1000 because you're among the 1,000 largest stocks. On the other hand, if you're a stock that was ranked 995, okay, you're very close to that cutoff. What they're going to do for you is they're going to say, all right, we're going to look at where you were last year and keep you there. Okay, so what Russell's trying to do is they're trying to keep roughly the 1,000 largest stocks in the Russell 1000, next 2,000 in the Russell 2000, but they don't want to have stocks going back and forth from one year to the next. So that's why they kind of create this band. And the band is roughly 200 rankings. So if you're somewhere between 800 and 1,200 in your ranking, you just stay put where you were. Okay? So that's how Russell assigns stocks into indexes. All right. Then, after you are assigned to an index, they give you your portfolio weight based on your weighting within that index. Okay? And so what's going to happen is that the smaller stocks are going to get pushed down to the bottom of the index, get a very tiny weight. Bigger stocks in terms of market cap get pushed to the top. Okay? All right, so why does this weighting matter? Okay? Well, what's going to happen is you can imagine you have this company that was ranked 1,005. Okay? It gets put into the Russell 2000. Okay? It is one of the largest stocks in the Russell 2000. Okay, so it's going to get a big portfolio weight. Whereas you have this stock that's 995, it gets put into the Russell 1000. It's one of the smallest stocks in the index. It gets a tiny weight, right? And here what we've done is we've plotted the portfolio weights. So these are the portfolio weights for the bottom 500 stocks of the Russell 1000. And here are the portfolio weights for the top 500 stocks of the Russell 2000. Okay, it's about an order of magnitude jump around that threshold. Okay, now why do these weights matter? Well, let's think about $1 of indexed money. Right? So if you have an index fund that is invested in the Russell 1000, invest $1, very little of that's going to go into the stock at the bottom. Okay? But if it invests $1 into the Russell 2000, a lot of that's going to go into the stock at the top. Okay? So what's going to happen is that you're going to get a bump up in ownership because it turns out that there's actually a relatively similar amount of money passively tracking these two indexes. Right? Even though the Russell 1000 is much, much bigger in terms of total market cap, it's not a very popular benchmark for all these index funds. Why? Because it competes against the other large and mid-cap funds. So it has to compete against the S&P 500. Okay? Whereas the Russell 2000, that's the small cap fund that most indexes will benchmark against. Okay? And so in the data, what you're going to see, if you just look at, here's how much money passively tracks the Russell 2000 versus here's how much passively tracks the Russell 1000, you should predict about a 40% increase in your index ownership if your stock is assigned to the top of the Russell 2000 rather than the bottom of the Russell 1000. Okay? And so what we did in the paper was we then try to go and look and see, is this actually the case? Do we see this jump in index ownership as we would expect based on the relative popularity of these two indexes? Okay, so to do that, what we did is went and got ownership data of mutual funds and ETFs. So this comes from their S12 filings. So all mutual funds and ETFs have to report on a quarterly basis all of their holdings. So we have that data. And then we try to classify funds into, all right, this is an index fund, this is not. Okay, now how do we do that? Well, basically, we look at the name of the fund. Right? So if the name of the fund has a word like index in it, then you're an index fund. If it has a word like Russell or S&P 500 or 1000 or 2000, we classify you as an index fund. Okay? Or if we're able to match you to the CRISP mutual fund database, and the CRISP mutual fund database flags you as an index fund, we'll classify you as index. Everything else that we're able to match, we're going to just say that must be actively managed. Okay? All right. Once we did that, we then compared. How does the ownership look different for the companies at the top of the Russell 2000 versus those at the bottom of the Russell 1000? Do we see that jump in index ownership as we would expect? And the answer is yes. Okay? It is about a 40% jump. It's about a 4 to 5 percentage point increase in your index ownership. Right? So you have two stocks that are otherwise very similar. It's just one is at the top of the Russell 2000, one's at the bottom of the Russell 1000. And you get this big jump in index ownership. Okay, now you might say, well, 4 to 5 percentage points, is that really that big? It is pretty big when you think about these three main investors, BlackRock, BGI, and State Street. Right, so if we hone in on them, and again, remember they account for about 80% of all indexed assets in the US. For each of those three institutions, on average, their ownership stake is about 30% larger if you're at the top of the Russell 2000, rather than being at the bottom of the Russell 1000. For each of these three institutions, on average, their likelihood of owning more than 5% of your shares goes up by 60%. And for each of these institutions, their likelihood of being one of your top 5 shareholders goes up by a little under 20%. Okay, so those institutions are just much, much more prominent in the ownership structure of a company that got assigned to the Russell 2000 rather than the Russell 1000. Okay? And that's a variation we're going to be making use of in our identification to try to look at their impact on activism. So broadly speaking, what we're going to do is we're going to pull out stocks that were targeted by an activist at some point during our sample that are relatively close to this threshold. So they're very similar in terms of size, it's just one is in the Russell 2000, has a lot of index ownership, the other is not in the Russell 2000, doesn't have a lot of index ownership. And then we're going to compare the outcomes of the activism campaigns and see how they differ. And we're going to attribute whatever differences we observe to being driven by the differences in index ownership, because there's no other differences that we can observe. Okay. All right, so now what we needed to do is get some data on activism campaigns. What happened in all these campaigns? What were the outcomes? What were the strategies of the activists? And so on. To get that data, we used the SharkWatch database provided by FactSet. They get a lot of their data from their 13D filings. So if you're an activist and you target a company and you own more than 5% of the shares, you have to file a 13D form to kind of say what you're up to. But they also have a lot of information on campaigns that didn't file 13D. They get that from company press releases, from the popular press, and so on. And they basically just give you a lot of information in terms of, all right, here's when the campaign started, here's what the activist was trying to do, here's what the outcome of the campaign was. Okay? So we go and collect this information from their database for all activism campaigns that targeted a company that was within 500 ranks of that cutoff in the Russell 1000, 2000. And we do that for the years 2008 to 2014. Okay. So this gave us information on 466 campaigns targeting a little over 300 unique firms. All right, so what are we going to look at? Okay, again, there are three main things we're going to focus on for these activism campaigns. First, we're going to look at the goal that the activist sets. Okay, are they going for a board seat? Are they going for a dividend change? Are they going for a change in leverage? And so on. Okay. Next, we're going to look at the tactics. Right? Did they write a letter to the managers? Did they do a proxy fight? Okay. And then finally, we're going to look at the outcomes. Did they win whatever they wanted to do? Okay. Or did they lose? And does that vary with index ownership? All right. So the first thing we look at are the goals. Okay, so using the SharkWatch database, we can roughly classify activism campaigns into one of three goals. Okay, and what I've done here is I've ordered them in descending order from the most sort of ambitious down to the least ambitious campaigns. So generally, the most ambitious type of campaign is where you're seeking board representation. You actually want a seat at the table, gives you the ability to influence lots of different policies. Okay. The second type of campaign is when an activist targets a company and says, hey, we think you should make these changes. They'll improve firm value and shareholder value. Okay, for instance, maybe ramp up payouts or change leverage or spin off this part of a company. Okay, you want these changes, but what's different from the first one is you are not seeking a board seat as a way to implement that changes. Okay, so it's a little bit less ambitious. And then finally, there's this other category which kind of catches all this miscellaneous things, for instance, of where you just put up this non-binding shareholder proposal, you're doing an exempt solicitation that's kind of a vote no campaign where you're trying to get everyone to vote no against the manager's proposal, and so on. Okay. So what we do first is we try to look at whether the presence of these indexes is associated with the type of campaign that the activist decides to launch. Okay. And we find very strong evidence that there is a shift in these campaigns, and that you see a shift towards the more ambitious campaigns of seeking board representation when the index ownership is higher. Okay, and it's a pretty large shift. Okay, so if you're assigned to the Russell 2000, which again is associated with about a 4 to 5 percentage point bump in index ownership or a 40% increase in index ownership, the number of campaigns that are targeting board seats doubles. Okay, you're twice as likely to have the activists, if they target you, go after a board seat. Okay? And you're seeing a decline in the other type of campaigns. So I should note here, we don't see an increase in the likelihood that you're going to get targeted if you're in the Russell 2000 and if you have more index ownership. But if you are targeted, the campaign's going to be much more ambitious. They're going to be more likely to go after the board seat and less likely to do these sort of small campaigns of non-binding shareholder proposals. Okay. Then the question becomes, all right, well, why are the activists more likely to go after a board campaign? Okay, why are they more ambitious? Well, one possibility, getting back to something I mentioned earlier, is that the presence of these index investors might actually make it easier for the activists. In particular, one of the strategies that you would typically need to employ if you're trying to get a board seat is do a proxy fight. Right? And it's possible that the presence of these indexers makes proxy fights less costly or more likely to succeed, which means they're more likely to do it. Okay, so why might that occur? Well, again, there's a reduced cost of tracking down investors, right? If you're being held by Vanguard, BlackRock, State Street, I can just approach their governance divisions. That's relatively easy for me to do, right? And if one or two of them kind of say publicly, we're going to side with the activists, I'm likely to win. Okay? The passive institutions might be more attentive than the retail investors. Okay? So that could make it easier for you to sort of rally support and win your campaign. And then finally, again, they're more reliable. Right? You talk to these investors, you make your pitch to them, you know they're going to be there when it comes time to the vote. They're not just going to sell their shares. Okay? So all these could make it more likely you're willing to go for that proxy fight, which is very expensive to do, and try to get that board seat. Okay? So we try to look at this next. Do we see them changing their tactics? Are they more likely to do a proxy fight when they see more index ownership? And the answer is yes. Right? Again, it's very sizable. When you're in the Russell 2000, the likelihood that you're going to face a proxy fight if you are targeted by an activist nearly doubles. Okay? Moreover, the activists appear to be more ambitious. They're going after more seats on average when you have more index ownership. Okay? They go for an extra seat usually. And finally, they're more likely to be successful. Right? We can see in the data, if you're in the Russell 2000, have more index ownership, the activist goes after a board seat, they're more likely to do the proxy fight, and they're more likely to get that board seat. Okay. All right, so it seems like the presence of these indexers is helping the activists in terms of going after board representation. The last thing we looked at in the paper were other outcomes. Right? So board seats are not the only thing that activists go after. There are a lot of different types of campaigns. And so we try to see if there's any evidence that the presence of these indexers is helping them with these other types of campaigns. And the evidence is mixed. When you look at campaigns that are related to corporate control or quality of the directors or poison pills, things like that, the activists are more likely to succeed when the company is held by more of these indexers. Right? So for instance, if they're trying to acquire the company in a hostile bid or trying to get that company to sell itself, they're more likely to succeed if passive investors' ownership is higher. They're also more likely to get rid of takeover defenses like a poison pill. Okay? Now these all actually kind of make sense because if you look at the proxy voting guidelines of these indexers, Vanguard, BlackRock, State Street, these are exactly the issues they talk about. They're all about making sure that the companies are not entrenched, don't have these takeover defenses, have high quality boards and high quality directors. On the other hand, if you remember, Larry Fink was talking about activists in that they might be short-sighted, they push for these dividend increases, leverage changes. When we looked at those outcomes, we don't find an impact, right? Having more index ownership of your company does not affect the activist's ability to succeed in giving that dividend increase, giving that capital structure change, or that spinoff, which fits with the idea that this is not something that those indexers are primarily interested in. Okay, so to conclude, it does seem like these two trends that we started off with, the rise of activism, the rise of indexers, that they are connected. That the rise of index investors, the growing popularity of those type of investment strategies, and the fact that it's a very concentrated industry is facilitating the ability of these activists to get involved in these companies and enact changes. Okay? We think our findings are interested in a number of other dimensions. In particular, we're focusing on what the activists do after they get into a company. A lot of the prior literature has been about, well, who do the activists target? Okay, typically they're going to target a company that's not performing as well. Okay, but there's been a bit of a black box in terms of why do they do certain things when they target different companies? Why do they go for a board seat here and not here? Right? And we're basically showing that, hey, the ownership structure is going to matter here. When you get into a company, you have to see who the owners are and then game plan from that. Okay? And then finally, our results are showing that these passive investors matter through multiple channels. Right? So some of Ian, Don, and I's earlier work had looked at the direct voting ability of these passive investors. Right? So Vanguard, BlackRock, State Street, they have these proxy voting guidelines. They vote very consistently in terms of they like independent directors, they don't like takeover defenses, they don't like dual class shares, and you can see it in the data that their voting seems to have an impact on these companies. Here what we're showing is that their presence is also affecting another group of investors, the activists, who are important in terms of monitoring managers as well. Okay, thank you.
We have time for a few questions. So starting with the...
I have a question. Did you look at the alternate explanation that might be that the 2,000 are just smaller companies? If I were going to try to influence somebody, I'd rather go after Hardee's Hamburgers rather than Exxon. I'd have a better chance of hitting a softer target than a big company like Exxon. Could that be an explanation?
Yeah, so we know that if you're in the Russell 2000 versus Russell 1000, it gives a big difference in index ownership. But as you're pointing out, those are based on size, right? But that's why we're choosing stocks that are very close to the threshold, so they're already very similar in size. And then that banding actually helps us because you'll have two stocks that could be the same size, just one is in the Russell 2000 because of historical reasons and the other's in the Russell 1000. So we are controlling for size. These are stocks of similar size and market cap, and they act differently.
Then the second question on what they're up to. You didn't have share buybacks and stuff like that. The really short-term kind of stuff.
Yeah, no, that was lumped in with dividends. I should have been clear there. So any type of buyback or payout through dividends, they don't seem to be more likely to succeed in that.
I mean, it sounds noble to go on the board. It sounds ignoble to just encourage buyback and run the stock up.
Yeah, no, I think what has happened is that the activists have kind of figured out if we're going to win these campaigns, given these indexers are very important now, we need to talk about high-quality boards. They're not interested in high payouts or ramping up leverage. And so they talk less about that now, and they're now focused on let's improve the board.
Okay, I have a question. So I closely watched Larry Fink. Larry Fink used to be my boss. I worked at BlackRock for a while, where I ran part of a global macro hedge fund. And they've since closed that fund. It was fine when I left it, right? But about 2 years after I left, they closed it. And they closed it because a lot of these kind of active hedge funds have closed, right? Because it's very difficult in this kind of zero interest rate environment to make enough money to justify the typical kind of hedge fund fees, basically. So they were still profitable. They couldn't justify 2 and 20 or anything near that. And as I remember, so Larry Fink's argument was, okay, we're going to move away from active management towards passive management. You're going to see much more of this post-crisis. And that is why we at BlackRock will become more actively involved in corporate governance. Because if you have active management, you can sell the stock, right? You can discipline boards you don't like or don't like their behavior by selling their stock, basically, right? But if you're indexing and you've got to hold the S&P 500 or whatever it is, you're indexing, you can't do that, right? You've got to have a positive amount of every stock according to the percentage that you want in your index, right? So his argument, so that would suggest, if Larry Fink's correct, then you would expect to see a change in behavior pre and post after the crisis, right? So that there would be a testable implication of whether it's the indexing or the rise of indexing or the further rise of indexing, decline of active management that's driving this.
So yes, that is a story that they tell. It's also something that Vanguard will say. Like they describe it as, we view ourselves as passengers in a car we can't get out of, right? And good governance is our seatbelt, right? And so that's why they claim to care about governance. But so you're arguing that this shift occurred around the financial crisis in terms of active ownership? I mean, for BlackRock, it certainly did with their acquisition of BGI in 2009. So they weren't so active or so passive before that. So for them, yes, I could see 2009 as being a big shift for them in the financial crisis.
No, but Fink's argument is we're going to, he's actually said when he put the 2016 letter out, we will now become more active. BlackRock, our governance department, we will increase that because we can't just you can't do the Wall Street walk anymore and just sell shares of boards we don't like. We're actually going to actively get involved. Yeah.
I guess I would say is I don't see the financial crisis as being a turning point in terms of passive ownership. If you look at the data, it's just been a steady uptick from year to year over the last 20 years. And there's nothing sort of unique about the crisis itself in terms of that. But I would grant that, yes, BlackRock's share of assets that are passive managed has been steadily increasing, which gives them all the more motive to care about these things because they can't sell those positions. Yeah.
And the other, sorry, I'm hogging the microphone, but the other issue about Fink's letter is that he actually says there are broader issues. It's not all about shareholder value. It's all about the environment, sustainability, employment issues, and so forth. Right? I mean, have you thought about that also? Yeah,
so that's a relatively recent shift for them. So they had a letter, I believe, last year to that effect. What's interesting, though, if you go back to the proxy voting guidelines of these big indexers to 2003, 2004, when they were first published, at least for Vanguard, I remember they actually had a paragraph that said explicitly, we don't care about that stuff. We view that as outside our realm of expertise. We're not focused on it. They have obviously changed their tune on that in recent years and now have made it a big focus.
Have you had a chance to talk to any activists and test your theory to see why they did what they did?
Yes, I mean, I did talk to a person at Trion, and he described it as a repeated game in that, I mean, so I was at a conference, so there's the head legal counsel of Trion there, who's sitting next to him, Glenn Burum, head of governance at Vanguard. Like, these people know each other, right? And so when they target companies, they're just constantly speaking to the same person. And so he described it as, we kind of know them, they know that we do good things. As long as you're an activist that actually creates value, it's actually helpful to be facing the same investor again and again. So he viewed it as positive, the growth of indexers.
You could look at activists, and I mean, there's lots, but you could take some of the more active activists and see if there's some patterns as to how they, particularly in their tactics, their objectives and their tactics. And I suspect that there's pretty good correlation.
Yeah, so different activists have different approaches. Yes, I would agree with that. But I think what's happening is that you're seeing the activists change their approaches on average because they're beginning to realize that these campaigns of being very aggressive and negative about the managers, quality managers, and pushing for dividend changes, that doesn't win the support of the big indexers. The indexers are more interested in you coming to them and saying, hey, we just think that they're making bad decisions, they don't have good directors, that aren't sufficiently independent. That wins the attention of these indexers. And so you're seeing them kind of understand that this is what they need to talk about. And so you're seeing more of those campaigns.
Thanks for the presentation. Have you seen with the rise of activism and the rise of passive, perhaps supporting activism going up, that the required stakes that an activist takes in a company come down?
Yeah, so we thought to look at that. So it could go either way. It could be that, hey, now I know if I can lean on these indexers and they could cast a vote in my favor, I don't need to take as big of an ownership stake. Or you could say, well, now that I know I'm more likely to win, I'm willing to take a bigger ownership stake. So it could go either way. We looked at it in the data. We don't find any effect on the size of the ownership stakes they take.
Questions?
Your paper, which I read, I got through all the academic phrases, sort of gave a blessing to this whole process. I have a bias on this topic. They're good people. They're noble in their purpose. They're not out for short-term gain. They're there to change the world, and especially if they get green companies now doing this stuff. And there's no doubt that you can run the stock up in the short term. I didn't see anything that talked about the longer term. What was the horizon with the implication that this is okay stuff?
Right. So in our paper, we steer clear of whether the activists are doing good in terms of improving long-term value. There wasn't something that we could look at in our study. But other people have looked at it, and there tends to be two pieces of evidence that suggest that on average activists are doing good. One is the initial announcement return. When they launch a campaign, on average the stock price goes up, suggesting shareholders think this is going to improve value. And then there are other studies that look at productivity of plants that are these companies that were taken over 3-5 years down the road, and they show that that also seems to increase. Okay. Now, that isn't saying that all activists do good and improve value. And in fact, as Larry Fink's comment would suggest, he doesn't think that all of them do well. Right? In fact, BlackRock only has supported all the activism campaigns. They supported 40% of them 2 years ago. Right? So there were 60% where they felt like, hey, they're just pushing for short-term things, not in the long-term interest, and they don't support it.
Have we got any Emerson people in here? I wonder how Emerson would feel about this.
Right, since they're being targeted.
They're
Yeah.
right in the middle of it.
Yeah.
One well-run company. Their stock doesn't go through the roof very often, but it's it's slow and steady. It's like oceanfront. And what's the matter? Why are they pestering Emerson?
Yeah, I can't speak to that one very much. No, but to the extent that if indexers are the ones that own 20% of Emerson, indexers are going to be interested in long-term value because they're going to continue to hold it. So if those are the activism campaigns you don't like, the short-sighted ones, it's the same with the indexers.
It's always an interesting definition of long and short term. Depends on the definition.
Yeah.
You can run up that stock in the short term very easily.
Yeah.
Sustaining it in the long term is a lot harder.
Right.
Great paper.
So how would you summarize the policy implications? Are there any?
I usually steer clear of policy implications. I wouldn't see any policy implications here. I mean, there have been discussions of these indexers becoming overly powerful and too controlling, but I haven't really seen any downsides of it. Seems to be only positive. So policy implication would be not try to break these guys up.
Just interested if you have any thoughts about some of these shareholder advisory firms and what role do they play as far as determining how the votes go, and in particular with, excuse me, with these index funds. So do I have to go to the index fund manager? Do I just have to go to ISS and persuade them, and everyone is going to follow suit as far as concentrating in voting power?
Yeah, so for the proxy advisors like ISS and Glass Lewis, there's a separate literature on that. They definitely have an impact. So if ISS recommends vote yes, big swing in the votes, okay? That is not the case for the indexers, however. If you look at the data, they are more likely to vote against ISS than other investors, right? So they buy the data, but these big indexers, Vanguard, BlackRock, State Street, they all have in-house governance divisions that make the decisions on how the fund family is going to vote. So they're less influenced by those proxy advisors.
Other questions? so much, Todd.
Thank you. Thank you.
Releasing us?
Yeah, well,
Oh, okay. We're looking for an official word.
Anyone wants the full copy of the paper?
oh, yeah.
Grab one or sign up.
Turned on.
Yeah, sorry,
Go to the bathroom.
sorry, I forgot to announce that, guys, you can get a copy of the paper over here if you'd like a copy. Or if you said give us your email address, we'll email a copy to you as well.
Well, that makes sense.
A long time. What are you doing these days? Oh, very good. Very good. Yeah. I'm still in Wells Fargo. Still there too?
Nice to meet you. Your colleague here, do you know Mark?
I don't think I know it.
So I'm going to ask Zach to fund it.
First couple of years.
So I'm going to put I'll do real estate and energy, so they want next to
Well, actually,
they were pretty empty.
I think the tower's pretty much full. I'm not sure
interesting.
on your side.
It was a new building.
And I'll tell you, compliance is just mushroom.
Wells Fargo, I can't imagine.
Oh my gosh, yeah.
I can't imagine why.
With all the consent orders and everything else with the bank. Yeah. Yeah, we've definitely expanded. We've got an area called testing and validation. That's just huge. So our compliance itself has grown quite a bit. Oh, I guess it's job security, right?
That's right. Our building, that's been set up as a new firm.
Yeah.
So I go by, you know, I would have all the same people town.
Yeah.
Ted,
So, yeah, so
I
it's
live
there,
I
yeah.
mean, it's like I see them every day.
I just ran into them last week at the Greensfelder thing. So, a lot of the same people, yeah. A lot of changes on the backside, I'll tell you that.
I bet they're just starting.
Oh, man, just when you think things are starting to calm down, another change comes. I used to work for, I guess before I went to AGM, I worked at Centerra Bank in their auditor.
Right.
And I said when I left there, I'd never want to work for a bank again. So here I am working for a bank.
A little more distant.
A little more. Yeah. Good seeing you.
Good seeing you.
Take care.
Good seeing you, then, Mike. Take care.
Good talking with you, Jeff.
Sophomore inventors bank routes.
Oh, yeah, sure, yeah.
The Chase branches.
Yeah, the branches.
Yeah, no, that's amazing. People say, no, well, but you know, I got handed a large check.
I mean, it'd be one thing if there was like something
Here's an overnight envelope. I can't touch that check. You know,
So what size are you on?
the private bank.
Oh, you're the private, so you're with the market.
I was rich.
You're wide, you're the size. I mean, it doesn't really matter.
Yeah, oh no, it's a good team.
I've been over, thank you for the, I know, right, you were in the Central.
Yeah,
Nice to meet you, Mike.
Well,
good. So,
hopefully we can.
there you go. Try to send them, we get job postings.
Very nice to meet you. Yeah, I'll definitely be there.
Our kind of project that affects the idea of like the index
Thanks,
fund,
Todd.
index investment. They're not really trying to identify over undervalued stocks.
Right.
Kind of dumb money.
You know, you were part of the team,
So our thought was that, well, if more of the stocks have like indexes, that's a stock that's usually in an alpha for the active. And we had some suggestive evidence on that, but we haven't kind of pushed it.
Yeah, I would be curious. I think that would be an interesting research paper.
Yeah.
Okay, thank you very much. Appreciate it.
I'll drop you an email.
All right. Thank you.
Yeah. And good to meet you. You met Christine?
Hi, Christine.
Yeah, it was
How
good
you
to
doing?
meet you, yeah. Yes, I do, yeah.
The Global Masters in Finance. So we have Jordan.
Yeah. I bet, yeah, so, I do business.
You are.
So we all.
Coach at NBA full-time. And,
Yeah.
I absolutely encourage them to take that.
Well, thank you very much.
Very different, very good pain.
No, but I'm glad you came, it was
Sequencing, I think, of the mass
fascinating.
content, but I've talked to some of the
How
people
does
in
that
GPO
all
that
work, you
have
know, yeah.
probably never really figured out the current class is gonna be tough.
Yes, you're talking
Secret's out. Did we give you a parking
I hope we
belt?
get enough of them through.
Oh, great, excellent, okay, okay.
Thank you.
I know.
I agree. I feel like you come out with 2 degrees in the same amount of time that others are just getting an MBA. You have more of the quant skills, and I think a lot of these companies are looking for. It's going to give you a leg up. So yeah, when they originally proposed that program, I always felt like that dual degree is going to be the most popular thing. I'm curious to see what the breakdown is in terms of how many chose to do it.
I think we have 23 to 25 signed up.
Okay, so only about a quarter.
I'm only on the crop side.
Promise is drop rate. That's my concern.
What's that? Oh, because it's just too challenging?
Yeah, and when I talked to the GPO, the graduate program.
So like,
office,
I started in
apparently somebody's
2001.
doing the analysis to find if there's sequencing of the classes. Where, for example, spring, A in the spring semester.
It was a huge event that Rob really started. We had him.
Yeah, he's a great guy.
We did the same thing this year.
I know that there
Brought
are
all
people
of
who
our
drop in the
investors
spring semester, that's really.
and we had scientists from the legacy bank and
So hopefully we
Santa
figure out,
together
sorry for this
presenting
one.
He's very nice. He's an incredible
You know,
friend.
fantastic, if we can say,
events like that will start to
we'll get you covered in the
the research culture more because you do
It's a hard
have
proposition.
Yeah.
We brought
a lot of
around 50
small
people in
molecule
pre-admin, so
research,
people who are
including
still in the late stage
biotechnology,
decision.
things like that.
That was big.
Hopefully some of these
In that room saying,
herbicide
if I was your
tolerance
age,
systems.
I absolutely.
I think
Yeah.
And
I understand the
full-time
challenges.
requires
The
that
hell,
to be
what the hell, I saw it went on the tried about it.
Yeah.
I already argued with it.
I know this is.
The same thing, yeah.
Right.
So doing it from the two.
Stay in touch with them.
Benefits to it.
Yeah, no, I agree.
But,
No, that's important that they promote it as much.
yeah, it's a learning experience, and I know, you know, if we can, it's not an if, because I know the program will continue. It's not, this is not a decision year, this is not a go or no-go decision year. But it would be stronger if we have enough people that do complete, that we can say, these people made it work.
Right.
Interestingly, in my opinion, because I know we get the cohorts of Asian, so Chinese students, Indian students, and then the domestic. Some of the people who are most strongly dedicated to it are domestic students, and that surprised me, with all due respect.
Yeah, I think that's crisis to me as
Yeah,
well.
so the Chinese students have told me that in China.
I think that's why you
Borrow
always
your,
wear ties,
Sophie's bib. She's gonna pull that out here next time.
isn't it? I was about to say, actually, I have.
Wait, we gotta.
They said in China,
I got a mess over here.